Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Hello and welcome. Before we start, I wanted to let you know that no AI, that is, no artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Chicago wheat. Okay, so there is a lot going on here in a relatively short amount of time. The top side has been dominated in recent days, despite a brief breach higher 3 weeks ago, by the combination of flatlining gold long moving average, currently at 565 even, and the flat dark blue trend line, currently at 570.25, which I will deal with shortly. I said 4 weeks ago, and I quote, "Please just bear in mind that beyond these we have some clear air up until the congestion at 588 and the March 2021 low at 592, end of quote. As we saw happen 3 weeks ago, with that breach, sharp run up, then capping by the congestion at 588 and the March 21 low, and the equally sharp drop later. I also added 3 weeks ago, and I quote, "A new pattern has emerged and seems to have taken over the running of this market. It's not a great looking pattern, but it is nevertheless still there and seems to be dominating the action. It is the mid-March to late June reverse head and shoulders pattern, with that previously mentioned flatlining dark blue neckline. Now, there's a lot going on in this pattern, but I'll draw your attention to one feature, and that is the mid-May early double top pattern. Well, it failed, and now should be considered not only as part of the second shoulder, but also a possible halfway hesitation pattern. And that's the end of that quote. Quite a long one. Now, I also spoke of this possible pattern during the prior week, so 4 weeks ago, and there were some elements there that I think you should still consider. And I quote, again, I'm afraid, "It is to look at the whole mid-March today action as a possible reverse head and shoulders pattern. Typically, this is seen as a bullish reversal pattern, but head and shoulders continuation patterns also exist. So I'll delay an opinion on which one until I have some further data. The neckline for this, well, I'd use the crucial gold long moving average right now until we see further developments," end of quote. As you can see, I finessed the gold neckline into a separate solid neckline. And I did have 3 weeks ago enough of a move higher, admittedly through some pretty empty space, to lay out some potential targets topside. Thus, a primary target X would be in the 616 area, whilst a secondary, harder to achieve target X1 would be in the 635 area. I finally added 3 weeks ago, and I quote, "I'll now watch and see if the pattern performs as a reverse head and shoulders pattern or not," end of quote. Well, this head and shoulders pattern as a bullish reversal has not performed well, as we've had a drop 2 weeks ago and again this week, if not as far. That same old gold long moving average and the dark blue neckline overhead have capped prices once again. However, we also saw once more the impact the purple neckline extension, currently at 534, had on the market, supporting prices from below early last week and late on the week before. All this being said, I will for now still keep targets X and X1 topside on my daily chart, but I've been looking at something else that might show a different point of view to this market, and this is where the so far unhighlighted mid-February to mid-June bearish Andrews pitchfork comes in. It is early yet on this one, but it might prove to be a better view of what is happening here than the reverse head and shoulders idea. For this pattern, we are right now in between the overhead upper time, currently at 580 even, and the middle time below, currently at 523. Please just keep an eye on this one, as it might just be useful. Chicago corn. 6 weeks ago, I drew a mid-February to mid-April bearish Andrews pitchfork, which, whilst not being exact, showed for quite a while the bearish angle attack of this market. However, the upper tine had been breached on a number of occasions, and 5 weeks ago finally broken. Now, I've still kept this broken pitchfork on my daily chart, and that's for a reason which I will now explain. I originally chose this steeper bearish Andrews pitchfork over the shallower bearish shift pitchfork for the same move, as I thought it gave a more suitable representation of the way the market was moving lower, which it did. However, and it is an important however, and I quote from 4 weeks ago when I said, however, that being said, the tine's next crossover this coming Monday the 19th of May, so watch out for one or more of the following then. A change in trend. A reinforcement of a trend. Volatility. Coincidentally, after changeover this week, that's back then, prices are now testing the 50% absolute Fibonacci line at 425. So it's worth being cautious right now, end of quote. The caution back then, well, that was well rewarded, as on Monday the 19th we had a combined key reversal up, if only just, plus a bullish engulfing pattern and a bullish opening white Mariposa, leading to prices rising up in the early part of that week, 6 weeks ago, filling in the changeover gap and thus fully justifying the earlier tine crossover warning I'd given. 5 weeks ago, with the break above the upper tine, I finally drew the shallower bearish shift pitchfork on the daily chart for the same move as the bearish Andrews, as the market transitioned from the steeper bearish Andrews to the shallower bearish shift pitchfork. Thus, right now we are in between the overhead middle tine, currently at 427.75, and the lower tine below, currently at 392 even. Now, before I review the very recent market action, there is a significant event I would now like to discuss, and one I highlighted 3 weeks ago, and again last week at a biofuels conference I was speaking at in Brussels, Belgium. It's actually 2 weeks ago. And I quote, "This ties in with the earlier crossover of tines back on the 19th of May. You see, the next crossover, indeed the last and possibly the least powerful crossover, will happen on the 24th of June. I've highlighted this with a bright red circle just above this picture of me on the screen. Be wary then, just in case we see a possible change in trend, or a reinforcement of a trend, and of course volatility, or even all three of these all at the same time. So caution." End of quote. Well, as you can see by the action on the 24th of June, 2 weeks ago, we had a break lower to new lows not seen since September last year, and it was only congestion at 403, plus the just below November 2020 low at 397, and the lower tine of the bearish shift pitchfork that halted and turned prices back up, thus fulfilling what I cautioned about so many weeks prior about that day. The subsequent recovery was not an easy one, as prices were capped late last week, thus stopping a possible weekly key reversal by the overhead and immediate 50% absolute Fibonacci line at 425, which in turn created a daily shooting star pattern, type 1 bearish. We also had nearby the December 2020 low at 414, which ties in with the low of late November last year, and we started this week with a gapping move lower, and in turn making new lows not seen since September last year. Prices in turn punched down through support that was fairly evenly spaced out at 409, 403, until the November 2020 low at 397, where we've halted. Also not too far from the lower time, which is currently at 392. Below we now have limited support, realistically at 386.5, then the August 24 and 2024 low itself at 385, before a low, not monthly lows, but just a low from late 2020 at 369 even. After this, well, we have at the bottom of my daily chart the old 2006 to-date uptrend. It's currently at 348.5. There is one other feature I would like to point out. It is a lagging indicator, but we had a dead cross of the medium moving average, currently at 452, moving down through the shallower declining long moving average, currently 453.5. Kansas City wheat. The major pattern here is a dark blue February to March bearish shift pitchfork. It's not a great looking one, having both the lower tine, currently at 478, and the upper tine, currently 573.25, pierced, breached if you will, but not broken. Thus both tines continue to play a role. A more significant role these days in showing the bearish angle of attack. Interestingly, in recent weeks, a new pattern has started to emerge, though this has also been breached, though not as yet broken, whilst at the same time some older resistances and I suppose supports as well have influenced the market. The older resistances, well, they continue to be the combination of the bright green lower trend line extension, currently at 564.25, of November 23 to April 24 descending triangle, plus the declining mauve medium moving average, currently 559.75, and the gold long moving average, currently 570 even. These, in reality, did not stop the market's rise, but they sure eroded the move higher 3 weeks ago, enough for prices to turn lower. At the same time, the support of the 38.2% absolute Fibonacci line at 532.5 and the low of August 2024 at 527, which was in turn created by that same 38.2% absolute Fibonacci line, managed to hold up prices below over June, and along with the middle time erode the bearishness we saw last week and this week. We also had the development of another pattern, one that started out as one thing and developed into something else. You see, I said 3 weeks ago, and I quote, "The short purple upper trend line, currently at 572 even, of the interesting mid-May to date bullish halfway hesitation. This pattern is interesting as it started as a possible double top pattern, a quite good looking pattern that then became a small expanding wedge pattern that was part of what is a larger bullish halfway hesitation." End of quote. This original double top that became a small breached on the top side but repaired expanding wedge pattern with aspirations to be a bullish halfway hesitation, well, in the end, it failed to live up to all the promise of this bullish halfway hesitation out there. Instead, has seemingly reverted to a breached and now repaired small expanding wedge pattern, which is currently 524.5 to 572 even. Last week, and especially this week, we have seen the testing of the support there, even a breach, but a breach that may have seemingly been repaired. I would suggest that this purple lower trend line, along with the dark blue middle time of the bearish shift pitch hawk, are the patterns to watch for the immediate future, despite their battered conditions. There is one other factor to bear in mind. It is an old one, and something I've spoken about most recently 3 weeks ago, and ever since, and I quote, "There is one other thing to consider, and I've not highlighted it as it's on my daily chart, but it's becoming increasingly significant. 7 weeks ago, that's now 10 weeks ago in real life, 7 weeks ago prices broke down through the lower time, currently at 553, of the significant, if very shallow, late August to early December 2024 bullish shift pitch wall, the one I was considering retiring. I've kept it on as these past few weeks prices have moved back over the broken lower time once more." End of quote. Well, since then we have dropped once again below the broken lower time, then back up, but now dropped even lower. I'd still nevertheless keep an eye on this one. Last week I was wondering if this pattern, this broken lower time of this pattern, had become something of an attractor for the market. This week, well, it doesn't look like it anymore, if it ever did so in the first place. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.